Welcome to Minus Stack, where we talk markets, big tech, AI, and what operators actually care about.
I'm Alex.
And I'm Jordan.
Let's start with the markets. Big picture first, then the headlines.
What's actually moving today? Walk me through it.
Yeah, indices, rates, how nervous investors are. Let's go.
What's actually moving in the markets this morning, and where does the China AI headline fit?
As of this morning, the S&P 500 is up 1.2%, the Dow is up 0.9%, and the Nasdaq 100 has jumped by 1.5%.
Solid day. And the story catching flow is China's cheap AI pulling capital toward internet names instead of chip makers.
I don't buy that low-cost models automatically re-rate every platform stock. Show me where cheaper inference shows up in gross margin.
That's the market narrative, not the margin proof. I wouldn't be surprised if the trade is really margin relief at scale, not a blanket tech rally.
Fair, cheaper inference leads to higher utilization on existing apps than multiple expansion only where AI is already a revenue line item.
Does that re-rating hold if US investors still apply a geopolitical discount to China ADRs?
That's the skepticism I keep raising. The product story can improve while the discount stays sticky.
Fair. After years in the chipmaker's shadow, internet giants finally have a narrative that is not just capex catch-up.
Only if you mark which names are earning it versus riding beta.
To your point on margins, sentiment can lead fundamentals for a few quarters.
Sure, but I'm not letting narrative substitute for capex math or fear-driven multiples. How long can sentiment run ahead of reported margins before the re-rating breaks?
Tier 2 for stock attractiveness, pending margin proof, and how long the geopolitical discount persists.
I'd put it Tier 3 until we see 2 quarters of inference cost showing up in reported margins, not slide decks.
Reasonable bar. Execution still has to convert the headline into numbers.
If you do one thing this week, tag your China tech exposure by revenue line. Inference savings versus pure sentiment beta.
Good action step. Map which names actually capture the margin, not just ride the theme.
That sets up the hardware angle nicely.
Same thread, different layer. Anthropic is building its own chip team to co-design silicon with Claude. Story 2.
Anthropic hiring a dedicated chip design team is the clearest signal yet that Model Labs want control of the full stack.
Ambitious move, but what competitive edge does in-house silicon actually buy them?
I don't buy that a job posting closes the gap with NVIDIA overnight. Show me tape out to deployed inference.
That's the press release, not the fab timeline. I wouldn't be surprised if the real win is cost per token on their own kernels, not bragging rights on custom silicon.
Okay, walk me through the chain. Co-designed hardware, model-specific operators, then higher utilization on owned accelerators.
That's the mechanical edge if they can actually ship it. Does that bet survive if partner fabs slip or the first revision misses power targets?
Build the team fast, but fab capacity contracts and the stepping plan have to hold. Same hardware skepticism as always.
Demand for Claude is already straining supply, so who gets the first wafers still matters.
Sure, watch the governance headlines, but I'm not letting policy talk substitute for production schedules.
Tier 2 for strategic vision. Custom silicon is directionally right, even if the timeline is messy.
Tier 3 for immediate product impact until we see silicon in production, not just job listings.
Fair split. Vision versus proof. To your point on timelines, a roadmap without silicon on the dock is still a slide deck.
If I could recommend one action, track hiring velocity against public fab partner milestones.
That's where the story gets real.
You said it yourself. Still a slide deck until wafers hit the loading dock.
Help me understand where co-design actually shows up in inference cost per token. Solid action step, bridge the roadmap slide, and the actual silicon on the loading dock.
Hardware control is one axis. How capital finds founders is another.
All right, story 3, why Lightspeed is going all in on creator-led venture capital. The check is moving earlier in the funnel, and creators are becoming the trust layer before founders ever pitch.
I don't buy that audience size equals investment diligence. Show me where creator sourcing improves realized returns.
That's the brand story, not the return profile. I wouldn't be surprised if the edge is warm founder access at seed, not better Series B picking.
The mechanism I'd buy is creator distribution, feeding curated deal flow, then faster conviction before the round gets competitive.
That's the mechanical edge, if the creator's brand survives a bad outcome. Does that model hold when one blown deal tarnishes the persona that sourced it?
Build the brand fast, but incentive alignment and carry structure have to hold. One public flop can freeze the funnel.
A16Z bought Turpentine, OpenAI bought TBPN, and now Lightspeed adds Claire Zhao. The playbook is spreading fast.
Sure, firms need new founder channels, but I'm not letting hype substitute for portfolio discipline.
Fair. Distribution advantage is real even if returns are unproven. Tier 2 for operator relevance, pending a creator-sourced exit that clears hurdle rate.
Tier 3 for fund returns until we see a creator-sourced exit that clears their core hurdle rate.
Reasonable. Experiment with upside, not a replacement for underwriting. To your point on discipline, speed without diligence is just marketing.
If I could recommend one action, stress test one creator-sourced deal in your pipeline against a traditional sourcing path on terms and diligence depth. On the margin, it is lower kernel latency on owned accelerators, not a marketing claim.
Solid action step. Compare whether the creator path actually buys speed or just buys confidence.
Run the same diligence checklist both ways and compare term sheets, not just warm intros. Capital and chips set the table. Deployment efficiency closes the loop.
Same thread, different angle. Story 4 asks why China gets more AI output per dollar than the US.
This last story isn't really a governance headline.
It's why China gets more AI output per dollar than the US. And the easy answer is always better policy or state coordination.
I don't buy that governance spend automatically equals efficiency.
That's the headline, not the mechanism.
Show me where the spend converts to compute per watt.
That's the test, not another ethics working group. I wouldn't be surprised if the gap is mostly deployment speed and labor cost, not magic policy.
Right. Concentrated capital, faster data center build, and higher utilization on the same silicon.
That's the mechanical edge. Does that concentration actually survive if 2 of those 3 data center leases slip?
Build fast, but the leases and power contracts have to hold. That's the timeline skepticism I keep raising.
Who gets prioritized still matters, whether that's Anthropic shaping US policy or Beijing directing build-out.
Sure, stakeholders should have a voice, but I'm not letting ethics substitute for the CapEx math.
Tier 1 for urgency, because this is where regulation meets real infrastructure dollars.
If I could recommend one action, map where your org's AI spend actually lands. GPUs, power, labor, not just governance slides.
Solid action step. Bridge the spreadsheet and the headline before the next budget cycle.
This thread ties all 4 stories.
Capital, chips, creators, and who sets the rules on deployment. And if the US wants parity, it's probably faster permits and utilization.
Not another round of abstract governance talk. To your point on deployment, faster permits beat another ethics working group.
That's the through line for today. Capital, silicon, distribution, and deployment math. Was there a moment this week when one of these stories actually clicked, or is it still all headline noise?
For me, it clicked when we connected AI demand to physical constraints. The model may be digital, but growth still depends on power, construction, security controls, and regulation.
That's minus stack for today. Markets, AI, operators, one take to sit with.
Go build one thing. Be the AI person on your team, for now.
Later.